So what we're doing here, I have a special guest, Mitch Jaworski.
Correct.
That's the last name. And Mitch is a big um, fan of stocks. So he has been studying it for years and years and years. He has a couple of books. And Mitch, you can talk about that also yourself, show
Sure
some books
thing.
that you have um, in this video. And today we are actually kind of breaking down to basics. I found myself that there are some things that maybe I should know, but I don't. And I reached out to Jason to just kind of go through this 2020 stock survival cheat sheet to break it down by bullet points. And that is pretty much tailored to folks who didn't start investing in stocks or struggled to understand stocks, or because they didn't understand, they didn't start to investing. So there's a lot of limiting beliefs around this. And I think we can break them down and kind of give a little bit more clarity and show the foundation of that versus just like, hey, go ahead and invest. We all talk about and hear about that, but the basics is the key. So it's like a chemistry. You have to know the basic formulas to generate more complex formulas and recipes. So, Mitch, thanks so much. And we can just go ahead. I think we'll probably spend 15-20 minutes
Yeah.
here.
So, I mean, in the end, um, it's one thing to understand the stock market. It's also another thing to kind of have a perspective in terms of how you should invest. And, I wrote this little 2020 stock survival cheat sheet a few weeks back, and Dorina had given it a look and, basically had some questions because she's a complete newbie when it comes to stocks. And she's always looking to improve her investing acumen. I mean, she's crushing it in real estate, and now she wants to, kind of understand stocks, which is smart because you want to diversify. Um, I have been investing in stocks for almost 20 years now. I was a full-time day trader for 5 years at one point, and then I got involved in real estate. And Doreena's been actually awesome helping me out in that space, especially in the state of Massachusetts. So
Welcome.
yes,
I'm too
yes,
happy.
good
I'm
old
too happy right
Massachusetts.
now.
So anyway, the least I can do is share some of my stock investing experience with you. And I made this guide because a lot of people started hitting me up asking me about stocks because the stock market was flying around like crazy, late March, early April with, basically the crash. And then we've gotten quite a bit of a rebound since then. So, you know, people that I've known for decades were hitting me up asking about stocks and just like, hold on a second. When did you magically become like a stock trader? Like, that's point number one. Like, stay in your lane, so to speak. And that's not like to kind of like belittle anyone. It's more so like you have whatever it is you focus on. You have your career, your current job, or your real estate investing, whatever it is. So you don't have time to become an active trader. What you have time to do is add stocks to your overall long-term portfolio. So the first thing is to take a long-term point of view, and that was the first thing I really kind of wanted to instill in people's minds, and kind of why I created this little cheat sheet. So I mean, we can kind of just run through the cheat sheet real quick, and basically, um, these key notes I put here were just basically kind of like FYIs, like the market's irrational right now, and even though we were going down, and we may still go down again, um, if we get some kind of vaccine or just cure, so to speak, for COVID-19, I mean, the market's probably going to rip higher, in the short term. So it's it's good to kind of keep that in mind. But also, the economic damage that's getting done right now isn't something we're going to just magically unwind when, everything quote unquote goes back to normal in a couple months. So this is one of the reasons why I want people to have a long-term point of view, because it's just like if you're going to start investing in stocks now, just know that things could go lower. The stock market could go lower. I mean, when Q2 earnings start coming out later this summer, they're going to be ugly, and the stock market might not have that priced in yet. So sadly, things could get worse price wise. It doesn't mean they will, The March low could be hypothetically the bottom, but just know that that possibility is out there. So that's why I kind of want people to start building this long-term view so they can slowly build into things that they may want to hold as long-term investments, just like you would, kind of when you're shopping for a rental property that you want to hold as a long-term investment. So that's really my point here about the investing versus trading. But before I get into that, I'll just touch on, in case anyone doesn't know, what the S&P 500 is. There's major indices. Generally, you'll see that on the news. They talk about like the Dow Jones was up or down X amount, or the Nasdaq, and then they'll also mention the S&P 500. The S&P 500 represents the five largest companies that are trading in America, and that's based on capitalization. So obviously, your Amazons, your Apples, your Facebooks, your Netflix, your Microsoft. And the reason I named those five is because those are actually the five biggest players in the S&P 500. In fact, they actually make up 20% of the S&P 500's movement. So if you want to have an idea what the market's doing, paying attention to those stocks will give you a little bit of a heads up because the market's not going to continue to move up without those stocks, and it's not going to continue to go down without those stocks, also going in that direction. So that's essentially what the S&P 500 is. It's just the 500 largest companies. I think it's a better gauge because it's broader. It gives you a better representation of all of, kind of like the economy as opposed to Dow Jones, where it's just 30 stocks. And, one really bad day by Boeing can totally take down the Dow Jones average on a given day, as opposed to the S&P 500 that has many more big players and many more stocks to kind of mute what one single stock does. And then the NASDAQ, which a lot of people are familiar with, that is very tech centric. It's mainly tech stocks. It's got commingled a little bit in recent years, but it's primarily technology related stocks. So that doesn't give you a clear representation of, the overall stock market because it's just one sector, so to speak, it's focused on. And again, it's not only tech, but it's still definitely tech heavy.
Mm-hmm.
So this is why I like this S&P 500 to track the market, engage the health of the market, and kind of like the price action. Um, so yeah, just to kind of circle back to the investing versus trading, again, that was my point about, you know, paying attention to the long term. Most people have jobs, most people have careers. Just because right now and for the last few weeks you've been home because of COVID doesn't mean you're magically a day trader. I mean, like I said, I've been actively investing for almost 2 decades. I was a full-time day trader for 5+ years, and I spent the first year or two just learning how to not lose money day trading. So day trading is not something you just magically pick up and you're good at. You can get lucky here and there for a little bit. No different than really like sitting down and playing poker for the first time. But it's not something that you can just jump into and make money for any extended period because the stock market is a very irrational place and it will test your emotions. It is literally psychological warfare if you are day trading stocks. And trust me, I know from many, many experiences and having my emotions swing up and down. But that's why we want to focus.
Interesting.
Yeah.
Mitch. I've listened to someone talking about their tenants not paying, but they're doing day trading, making money,
Wow.
and pretending that they're not making anything. And this sort of quarantine is working for someone really well. Though we both understand and everybody understands, once we all go back to normal, your priority is focusing on education for the long term
Yes.
versus day trading, which is truly temporary. It's a gamble, as far as I get.
I mean, in a way, a lot of people think, the stock market is gambling and they think day trading is gambling. And in a way, it is because, I mean, all it is, you're basically making calculated risks. I mean, when I have a good buddy, he's kind of a mentor. He is a veteran trader. He had a trading firm in Midtown Manhattan many years ago. Then he wised up and moved down to Florida, and he coaches traders still to this day, and he talks about that because the bottom line is, when people are doing trades, I mean, you have to have risk reward scenarios that make sense. Like you need to be making two, three, four times, the profit of your potential loss. And that's a big piece of, trading. So in the end, it's really just taking calculated risk, aka a gamble. I mean, there's no guarantee, obviously, that a stock's going to go up or down. You can essentially just look for patterns that have a probability of going in a certain direction, and then set up a scenario where it's like, all right, I can make $3 on the upside and $1 on the downside. If I'm wrong, I'll cut my losses there. So in the end, it kind of is why I understand people say it's gambling. I mean, it's basically taking calculated risks. So yeah, those principles you can kind of actually extrapolate into what I call active investing, and that's basically having a long-term point of view, but with the ability to kind of cultivate that stock position. So let's just say, like hypothetically, some people scooped up some stocks in early March, I'm sorry, in late March, and they've made a nice little return on their money. The market's bounced 15, 20%. Um, Selling off some of that isn't the worst idea. You know what I mean? Unless you plan on holding it for the next, 5, 10, 15 years, if it's a long-term position. But that's why I always tell people, I'm like, you can have long-term positions, and if you want to get active, you can kind of make smaller transactions around it. You know what I mean? So that's generally what I want people to focus on if you're going to be messing with the stock market. I mean, focus on the long term, and if you do want to be a little more, proactive, then check on stuff, every couple of weeks or every month or at least quarterly, um, and then go from there. But in the end, I would more so advise people to just focus on the long term and you know, build more so a portfolio for retirement because stocks should be part of the mix in your overall retirement portfolio. With real estate and bonds and even maybe some precious metals. I mean, I own all those. I own silver, I own gold, I own real estate, I own stocks. And there's some other alternative investments that I'd like to eventually get into as well. Um, so that's really kind of the mindset slash perspective I kind of really want to lay out. I mean, because leave the day trading to the people that do that for a living. Focus on what you're good at. Focus on what makes you money and puts bread on the table. And as far as the stocks go, just treat it like a long-term portfolio and do some pruning. Check on it at least every quarter. So with that said, I mean, there's ways you can do a better job of, positioning your portfolio for better entries and finding, stocks that might be value opportunities. And that's why I kind of just came up with a couple of these like hints. And, hint number one is live by that mantra, buy on dips, sell on rips. And it's something that we used to say all the time in the day trading office, but it holds true for long-term investing. Like, would you rather buy something when it's at, a 5-year high, or would you rather buy it after, it's had a pullback and, essentially gives you a bit of a discount? So, just think about right now, people who bought stocks in mid-February, bought the top of the market, and we might not see that top again for 3, 6, 9, 12 months, 2 years, who knows? I mean, I could be wrong, but I personally think the February highs are most likely going to be the highs for the stock market for the next 12 to 24 months. Again, anything can happen because the market can be irrational. There's a saying that the market can stay irrational longer than you can stay solvent. And that's a saying that really kind of took a lot of held a lot of weight, especially with day traders, because they'll short the market to go long the market, and sometimes it'll just keep going the opposite way, even though it makes no sense. It could be completely overvalued, whatever it is. It doesn't matter. It can keep going. But anyway, so that's the thing. Like, I try not to chase markets. So over the last like 6 months, we had this like extra push, especially the first 3 months of the year. 3 months of the year, we really pushed in the stock market, and it's just like, all right, well, if you're investing long term, whatever, you're slowly buying in. It's not the end of the world. But if you're going to get aggressive, do it when we get a nice pullback. Do it when you're buying at a discount. So we just got a 25, 30% discount on stocks. And, and some of that's come back because we've gotten a nice bounce. So, now maybe, those stocks are only down 10, 15, 20%. It depends on the stock. Obviously, every thing's different. Amazon's, higher than it was in February, but obviously stocks like, you know, Delta and all the other airlines and, the cruise lines and just, hotels, casinos, all that, they're all obviously well off those highs. So, you know, if you want to own those companies and you believe in them, why not buy them when they're beaten up as opposed to when, basically everyone's like, hey, this thing's kicking ass. Let me buy it. It's been going up forever. It's like, well, at some point there's going to be a pullback, buy that pullback. That's when you really want to get aggressive, So, if you're going to buy something for a longer term hold, buy more after, you get a really big dip. So, it's just to me a good mantra to live by. You buy on the dips, you sell on the rips, and it's just what we had. We had a huge dip, and then we had a big rip up, and some good money was able to be made. I bought some stuff in March that I unloaded, trading around my core position, which is again the active investing. So I have my IRA, and like I own Square, the payment processor. That's one of the stocks I hold. I bought more when we got that big dump because I love Square long term. I was willing to hold it long term. Like if we kept going down, I didn't care because I believe in that company in the long term. I think that Square is going to be a very profitable company, and that payment processing space and the fact that they are doing things also like where they do Bitcoin and some of the non-traditional stuff. I like that for the future of the company. But since it did get a nice rip, I'm like, screw this. Let me sell that extra I bought. I'll go back to my core position and book that profit. And if it goes back down, I'll buy it again. If not, I still have the original position I had and I can hold that for the next 5, 10, 15 years as planned. So, you know, that's why I think, there's sort of an opportunity, whether we, go lower or not, you still get buying at a discount. And, I got Warren Buffett's quote here, be fearful when others are greedy and greedy when others are fearful. So, when we crashed a few weeks ago, everyone was freaking out. Well, that's probably a good time to be greedy. But now, like, people started buying up stocks and we've kind of rallied, whatever, 15, 20%. And everyone's blowing me up, like talking about, oh, I'm going to buy this, I'm going to buy that. And I'm just like, you know what? That makes me want to sell because no one's scared anymore. So I'm going to book some profits. Um, so it's just, again, it's perspective, and it's just kind of like, buy on dips, sell on rips, be fearful when others are greedy and be greedy when others are fearful. If you essentially just live by those two mantras, you'll probably invest better than most people, better than like, the average mom and pop. And again, like, I'm quoting other people, very successful investors. So clearly there must be something behind them if, that's what these guys believe. So, yeah, let me move on and we'll get into like more technical aspects, so to speak. So really, I was trying to think of like what's the simplest way for the everyday Joe to essentially decide whether a stock is a good deal or not. And I basically decided that well the P ratio is one of the most common used ratios, one of the most widely known ratios, and it's an easy number to work with because you can be like, all right, average P ratio of the stock market is X. This stock is trading well below that, so it might be a deal right now. It might be a value. So with the P ratio, it's, and I have it up on the screen. It's literally just the um, market value per share divided by earnings per share. So, if a stock, is $20, you divide it by, the earnings per share, and basically you get this, you get the number. So it's pretty simple. There's, if you really want to, you can probably calculate it on a calculator, but you don't need to because if you check any stock quote, the P ratio is something that's available. So like if you go to like Yahoo Finance and you bring up a stock quote, you'll see like, just basic information. The P ratio is like the first thing listed. So finding the P ratio is the simplest thing to find. It's going to be available pretty much anytime you look at a stock quote. So with that said, um, you can basically use the S&P 500 as your gauge. And there's debate on whether the fair value of the S&P 500 is higher now because in the last decade or so, it has been higher. It's basically been in this like 18 to 21 range. But if you take the entire history of the stock market from the 30s, um, generally the S&P 500 average PE is from 15 to 18. 15 would be conservative, 18 would be probably a little more aggressive, but maybe more realistic for today's prices. So, it's a good benchmark. You can use it as a Mendoza line. So now if I see a stock that's got a PE ratio of let's say 10 and I know that fair value is, better than 15, closer to 18, then hey, I'm buying this stock at a discount. Now the question is this a stock that I believe is going to stay in business after the whole coronavirus thing passes? So, I just do a couple examples into this cheat sheet. And I put in some ones that are kind of, maybe even high risk because, I have Carnival Cruise Lines there. The cruise lines are getting destroyed and they're going to continue to get destroyed until we're allowed to go on cruises again, which isn't going to be for at least another 2 months, I think, based on what I saw the CDC put out there. So, do I want to touch cruise lines? Maybe not right now, but do I believe that we're still going to be going on cruises, a year from now? Yes, like it's probably not gonna disappear from our culture. So one cruise line will probably survive. Maybe it'll be Carnival. So their PA ratio right now is shattered. It's 2.8. I mean, at this point, it's like it's such a scenario where it's like, well, either they go bankrupt or I'm gonna end up making like 7 times my money. So it's just, it goes back to that risk reward thing, it's a calculated, risk. But, to get something with, safer, like think about, the airlines. Are the airlines going to go out of business? Yeah, some of them might, but is Delta Airlines going to go out of business? Is American Airlines going to go out of business? United, kind of the big three. Probably not because the government essentially is going to bail them out. I mean, they kind of already have. They were eligible for a lot of loans in that first bailout package. So that's the real question. It's like take a long-term point of view, find companies you believe in, and buy them while they're at a discount. And that doesn't mean they might not even get cheaper, but why not buy them at a discount? So you'll see in that last sentence I mentioned some safer names like Disney or Procter and Gamble. Do we think Disney's going out of business? Absolutely not, because even though their parks are doing no business now, they're crushing it with the Disney Plus streaming. They're crushing it with ESPN. You know what I mean? Like, so Disney's not going anywhere. I didn't look up what their PE is, but if their PE is, lower than the historical average, sounds like Disney's a decent discount. You got Procter and Gamble. It's just like it's a boring, safe stock. Is it going to give you returns like a Amazon or a Tesla might? No, it's not. It doesn't move like that. But at the same time, is Procter and Gamble ever going out of business? Nope. In fact, they've actually probably done pretty well because everyone was hoarding toilet paper and disinfectant. So, if I can get Procter and Gamble at a discount, sweet. If Procter and Gamble is lower than where it was in February, thank you very much. So, I think, investing in stock is a very personal decision. You have to decide, what companies you believe in. You have to decide, why you're investing to begin with and how long you're, planning to hold it. But again, I think the best scenario is to just keep it simple. Keep it as simple as possible. Like who needs additional stress, right? We got enough stuff going on in our lives. So why add stress with stock trading? Like just take that long-term point of view, buy stuff when it's on a discount, buy companies that you believe in that, aren't going to be going anywhere, that are going to be here 20 years from now. And, kind of just put yourself in that position for success because when you start getting a little cute with some of these high flying stocks, you can get burned pretty hard. But yeah, so like I said, solid stock. So let's just get to cheat sheet hint number 3. So kind of what I was just talking about, in terms of getting cute, like stop trying to time the market. You know what I mean? Like just stop it, please. Like you're going to drive yourself crazy. All right. The odds of you buying the exact bottom or selling the exact top are so freaking rare. And even if you do, who cares? Because the one time it happens, there's going to be 10 times it doesn't. So this is again why take the long-term point of view and just if you want to try and like time things, then buy on dips and sell on rips. You know what I mean? That's like as far as timing goes, just only do that, you know. So yeah, it's just don't try and, you know, figure out exactly when the market's going to top or bottom. Just take that long-term point of view, decide what you want to buy, and if you can try and buy it, if you get to buy it on a pullback, great, you know, but don't, you know, try and time it and wait for a certain thing to happen because it just many times isn't going to give you that. Um, but yeah, so that's the thing. I mean, and then I have, you know, a couple other just, you know, thoughts I wrote in here about, you know, what I said earlier about how the cruise industry, as an example, isn't going to completely disappear off the face of the planet, just like the airline industry is not going to. Um, but yeah, that's it. It's really that simple, like simple. Like that's the secret. Like those three little things. Like just buy on dips, and you know, find strong companies with a undervalued price to earnings ratio, and just don't worry about timing the market. Like done and done. Like that simple. Like it's really like keep it that simple and like you literally won't have to stress out about the stock market. You won't be thinking about it, you know, when you put your head down on the pillow. Um, and you know, times like these, we don't need any more stress. So yeah, that's pretty much it. And you know, in the cheat sheet, I put a few like useful resources. For being able to screen PE ratios. There's a site called FinViz that a lot of active traders use. But you know, it's got any possible metric you can think of. But you could go to it just to simply sort stocks by their PE ratio to see, you know, what's really low, and you can even like look at it, you know, by industry if you want to like let's say look at you know just
Mm.
airline stocks or just you know I don't know whatever consumer staples or oil or whatever. So yeah, that's kind of the gist of it. Keep it simple. So, any
Well,
questions?
yeah. I dropped a message in the chat box if anybody has any questions, because I'm very beginner in that particular type of investing. So that was very, very helpful for me. I think what I got the most from this session is that I will have to believe in the company, first of all, that is going to survive long term and it's going to be prosperous and wealthy despite of crisis. Um, a friend of mine said people always will have need for entertainment and parties. So I think any industry that is, I mean, people need to live somewhere and people need to party somewhere. So any cruise lines, any hospitality strong
Yeah, like
hotel
or Disney. I mean, you
division,
know.
Disney, it's not going to be anywhere. Even the poor people on the planet, they are partying, they're going and they're thriving for that piece of um, relaxation and
Yep.
partying because that's one of our essential needs. So I strongly believe in hospitality this year. It's going to go back up, especially cruise lines, especially airlines, and investing for long term um, will probably save you a lot of trouble. I do have a financial advisor, but he is
Yes, disclaimer, I'm not your
too smart.
financial advisor. I'm not your financial advisor. This
Yeah,
is for informational purposes only. Make your own decisions.
yeah.
I
And
was a financial
he's
advisor
doing.
many
Oh,
moons
you were.
ago.
Oh, okay. So, well, again, this is a very basic cheat sheet that I found very useful and just wanted to go over. Thanks so much, Meech. And maybe you can actually drop the link below so people can download that too to their desktop. Maybe go over or reach out to you with questions.
Yes, I should
And
actually have that handy.
yeah, and I think you are almost done with 401k book.
Oh
Do you
yeah.
want to just quickly chat about that?
Yeah, so I basically, obviously, and it's kind of frustrating. So usually I end up trying to empower people with knowledge on something when I see something that really just kind of you know bothers me that people are getting hurt, and in 2008 a ton of people got basically just wrecked, um, and saw their 401ks kind of just get cut in half, and all of a sudden their retirement dreams disappeared, and we're kind of seeing that again for a lot of people that were getting close to retirement. So I got this motivated to write this book, and I'm basically just creating a guide on how people can not only mitigate the risk in the different phases of their career and their retirement investing within their 401k, but also how to turn it into a kind of like a lean mean earning machine, because there's a lot of fees that people are paying that they don't realize they're paying, that they honestly don't need to pay if they just kind of select different investments that kind of give the same results. And it's frustrating when you are kind of getting your retirement stolen and you don't even realize it, because if you're paying 1% extra in fees and you do that over a 25-year span, you're not only just losing the money that you're spending in fees, you're also losing the additional income that would be created off of that money that has been spent in fees. So if you keep that 1%, that 1% is earning, over the years as well, and that compounds, and we all know the power of compounding interest. So I mean, a 1% difference in fees on your 401k could literally mean the difference of $100,000 in the value of a 401k when you retire. So yeah, I'm trying to get that book out for everyone as soon as possible so they can kind of take back their 401k. And for those that are younger, they can get more value out of their 401k over the next couple of decades. And for those that are getting ready to retire, they can see if they're overexposed to the stock market, which a lot of people are, and they don't realize it because they're in mutual funds like target date funds that are supposed to cash you out at a certain point. So you think they wouldn't be high risk, but a lot of them are very high risk in terms of holding a big percentage in the stock market still, which is dangerous to do when you're getting close to retirement. So yeah, the those are things that I'm really going to dive into, and hopefully I can have that out in the next few weeks. I appreciate you bringing it up.
Sure. And Mitch, we do have a question from Christina. She's asking, if you don't mind me asking, how is your portfolio balance stocks versus obligations right now? Which I think she means bonds,
Bonds,
stocks versus bonds.
like what do you mean, like my personal portfolio, or just like kind of like in general, like because you know there
I mean,
should be.
how do you look at the balancing between these two different types of
So here's
investing?
the thing that people don't realize that's important when you talk about balancing. It's also about, the volatility of an investment. So people think that if they're in 50% stocks, 50% bonds, that they're actually diversified like equally. And they're not, because stocks are historically 3 to 4 times more volatile, more risky than bonds. So you actually have to be much higher allocated to bonds than stocks in order to actually be at a 50-50 even risk level. That's what a lot of people don't
Mm,
realize. But for the most part, that 50-50 blend is still a good balance, especially, outside of, maybe if you're getting ready to retire in the next year or two, you should be, in my opinion, 50-50 is a good balance. But like I said, the younger you are, the more aggressive that balance gets. So I mean, it's basically like it's literally you could just look at it as a scale, and it's like when you're younger, it's going to be like this in terms of stocks versus bonds, and then as you age, it slowly should go like this and this, and then by the time you're getting ready to pull the trigger in retirement, you should be like this, where you only have a small portion of your um, portfolio in speculative investments, which stocks are considered a speculative investment. Because at that point, hopefully, you've built your nest egg, and that's the problem. I think a lot of people, their nest egg isn't where it needs to be or where they want it to be, so they stay chasing and they stay heavy on stocks, hoping stocks will get them to the promised land. And the sad reality is that just means you're not ready to retire. So yeah, that's the best way I can kind of explain that. You want that to change as you go through your life. Um, and obviously, people will chase returns with a higher stock allocation, and that's again, someone's personal decision. If they're later in life and they need to catch up, so to speak, you'll see people do that, and that's fine. If it works out, great. But obviously, right now, it's not. It wasn't the best play, over the last 6 months. So that's how I would describe it. But in the end, you want to find your best balance to find risk parity, and it's very difficult to do, with just straight stocks and bonds. But at least level it out so you know you're not completely exposed, especially if you're later in your career and getting close to the retirement.
Got it. Oh, thank you. Great question. Great answer.
I don't know where to share this
Um,
link. Where can I put it?
well, oh, okay. Let me see.
Am I?
Do you,
I have actually. Wait, I have your live going. I can put it in there. I did a watch party though, so now I don't know. Hold on, let me see. I'm just gonna put it in here and see if it pops up.
and if anything, this is being recorded, so we're gonna post it
Yes.
later. We can comment and drop the link below to this little cheat sheet and
Or what
also
I can do. Wait, I'm
to,
gonna be a genius. What I'm gonna do is I'm gonna Facebook Messenger you the link right now, and then
and
you'll
I'm
have
gonna
it.
post it. Okay,
Look
I
at
got
that.
it.
Sometimes I have good ideas.
You're getting better and better with your
My
tech
tech
skills.
skills. I used to be really good at tech skills. I let the times pass me by.
Okay, let me just,
But
okay, got
yeah, this
it.
is awesome. We got Facebook Live going. We got Zoom going.
Here we go. Here we go. Okay, all set.
Boom, there it
All
is.
right,
Nice.
awesome. So
Darina, awesome.
thank you.
Always good talking to you. Hopefully it was helpful. Obviously, if you got any questions, to hit me up, and it's the least I can do because I've bugged you so much about Massachusetts real estate over the last 6 months. So you've been a
Uh,
godsend.
well, I hope you can make it here soon and check on your property, check on your portfolio, and we can get that sushi going.
Yep. Yes,
And
exactly. I got to get up there. We're finishing up the flip. Well, we got 3 or 4 weeks to finish up the flip property. All the drywall's up now, though. So I'm hopefully going to be able to sell that in the next couple of months. We'll see how the market's looking.
got it. Well, I'm sure we'll see each other on Zoom tonight, Saturday morning,
So
and
many
we'll get
meetings.
it going. So many meetings. I mean, it's kind of fun. And again, thanks so much for your time going through this. And I'm sure people can see you here and they can reach out if they have any more questions
Yes, you can
or
find me
just
on
going back
Facebook,
to basics.
ScaredyCatGuide.com. Also, you can find me and all this good information. So awesome. Thanks again so much. It was great doing this.
Okay, awesome. Thanks.
All right, take care.
And now, bye bye.